Hello, everyone. I'm on Market Watch. This is just regular Market Watch, the one that everyone can open themselves. What I'm going to do today is look at a company that has been doing very, very well recently, Atkore Incorporated. Now, this is a 10K walkthrough, and so what I'm going to do is I'm going to get you comfortable with this company's 10K from 2022 so that your wisdom can blossom. Pulling up the financials, filter to 10K, go to 2022, and now we can get this show on the road. We'll start off by reminding ourselves that there's two goals that we have when looking through this. The first is to find reasons to like this management. Anything that this management is doing that shows that they're more competent than the average company. The second is to look for red flags. Any reasons why we would not invest personally. Now, the red flags will be very personal, and I will be sharing and trying to highlight what's a red flag for me versus what I could see some other investors being comfortable with, but just wouldn't be for me specifically. So, Atkore, here's that beautiful logo, Delaware company. We're going to see that a lot. Let's just go straight to the item 8. This is financial statements. Scrolling through, first we'll see what the auditors had to say. This one's pretty short and sweet. Honestly, this company's been doing very, very well. That's some context I have from before looking into this. They don't have any need for long audits. Usually when a company is very profitable, the audits are pretty straightforward. Maybe it shouldn't be that way, but that's how it goes. So how is this set up? We have 3 years. Annual figures, I love to see that personally, to be honest. Kind of implies there's more of a long-term view from the people preparing these figures. I like companies with long-term views. I suggest people like them as well. Net sales, cost of sales, gross profit right here. It is shooting upwards. Definitely make note of this. This is not normal growth in any company. And in fact, it's so aggressive that I'm actually waiting to pull out a red flag. Not quite there yet. Obviously, I'm not going to pull out a red flag because the company is making money. But why is it making so much money? Let's see if we can understand through the story of the financial statements. Both the costs that are similar to this and the SG&A are staying relatively flat, especially when compared to the growth of the gross profit. I'll just make a mental note of that. Don't have to overcomplicate it yet. As you expect, operating income is looking similar. Their interest expenses are actually going down, meaning this management is in some ways restructuring debt so that it has less of a burden on its bottom line. This could mean just straight up reducing debt, and that's what we hope it is. It could also mean shifting debt. And in fact, shifting debt with a lot of money coming in, that's something we'll want to check out later to make sure it's not what's going on. Income taxes are shooting straight up as they should, but this is good. There's no future expenses that are going to catch us by surprise. The income taxes are aligning with when the income is coming in, which is always a nice thing. It just simplifies things. And then this income per share, my goodness, this is the sort of thing that you really don't find ever. I'm very happy we're looking at this 10K together because this is either a miracle company basically, or we're just going to have to find out what else it could be. Now, the consolidated statement of comprehensive income. This is short. I typically don't like this to be very long, but this is very short. The only thing they have here are foreign currency translations, somewhat significant foreign currency translations, in particular for the year of this 10K. This is not something that I understand just off the bat. This is something clearly unique. How is it so short and how is this so meaningful? Maybe there's a lot that they consider a foreign currency translation that's going in here that some other companies might have broken down into more rows. Either way, pretty straightforward, I guess. The comprehensive income is sometimes a little bit higher, sometimes a little bit lower than the reported net income, but nothing too crazy here. I didn't think this was a young company, but this makes me think it's maybe a young company. I mean, they're an old enough company to have a pension benefits plan from several years back, but they really haven't collected a lot of differences. Either they've really, really focused on their income statements, which could be a good thing. It could also mean they're paying a bunch of unnecessary taxes, which, it's not my place to judge. When they're making this much money, maybe it's not the biggest thing in the world to worry about. But let's just keep in mind that this is quite short. Is this because they really know what they're doing, or is this because they haven't really thought about it much? Now, the balance sheet. Here's where we have the question about debt. Before I forget about it, I'm actually going to skip and go straight towards that question just because it's on my mind. That's how the red flag system works for me. Long-term debt here, staying pretty consistent, increasing a little bit. Interesting to note there's only 2 years on the balance sheet where there were 3 years on the other financial statements. That's fine, I guess. You just have a bunch of notes to add. So there is a note for long-term debt, note 13. Let's scroll down to note 13. Debt as of September 30th, 2022. Now, this will be more up to date than it needs to be for the purposes of financial analysis. Anyone's worried about, oh, we're in July 2023. Why are we focused on September 2022? For things like debt, this is absolutely recent. There's no need to be worried about what was going on in the last couple months, unless we have reason to suspect that there's a lot of effort being put into managing debt in a way that would be detrimental for the business. But I don't think we have any reason to suspect that right now. Let's just chill out and look at what debt was being thought about at the end of last year. And then consider what it might be some reasonable expectations for the future. Senior notes due June 1st, 2031. Those are lock solid at 400,000. Now remember, this is something they could pay off in 1 year now, given their recent increases in gross profit. And so total long-term debt is not a very high figure. What was going on last year in 2022 seems to be that they deferred a little bit less of their financing costs. And so they were paying up money a little bit faster. This is fine. Their long-term debt increased because they said, give us a little bit of what we could defer now. We have the money now. Might as well pay it now. I like that, especially with the way interest rates are always going to be a little bit uncertain. Might as well pay off debt when you have the money if there's no other better usage for that money. Now, could they be returning to shareholders? Potentially. Am I automatically upset that they're not returning to shareholders when they're growing so quickly? I don't think so. I mean, I'm sure they got a lot to think about beyond returning to shareholders at this point. This is bizarre. I don't know why they would include all these years. Maybe this is something they recently did. Maybe in wasn't that long ago where they had debt maturing at several of these years. Here they're really just emphasizing that 2028 and thereafter is where all their debt is due. As you can see, this is going to be roughly equal to their deferred financing costs plus their on the books long-term debt. That makes sense. Now, on here, you entered into a new $400 million, which is more than half of the total debt, secured term loan facility. So they owe more than half of it to one facility, which is, fine. It's not a crazy large amount for them. Variable interest. Ooh, I don't like that, especially with LIBOR. Well, it's fine. It's very common to have variable interest in loans. Their interest expenses could fluctuate more than you expected. So we shouldn't put too much certainty into what their interest expenses will look like in the future. Again, when this is less certain, what we want to do is compare this total number, 773, how much they're going to have to pay in the future with how much money they're making now. We'll scroll back up in a second, but in 1 year, they're making certainly more revenue than this. It should be a reasonably stable situation from this, quite stable actually. Let's frame what we just learned about debt with everything else that is going on in this book. Retained earnings shot up. Really, they've come into money. This is definitely congruent with what we were seeing on the income statement, which is that this company is coming into money. Now, what are they putting that money into? It's not cash. Their cash has actually gone down. The receivables, roughly stable. Their inventories, significant jump up. Not quite a doubling, but very much a significant jump up. This is the business making the commitment that they're going to be able to continue to sell at the pace, if not a larger pace. This is what a growing company tries to do. Often it works. It doesn't always work, though. Goodwill, up. We're going to go to notes 10 and 12. Maybe I'm not that pressed about. We're definitely going to go check out the note on the inventories in a second. Really good stuff on this liability side is they're growing and none of their liabilities are necessarily coming off a trend. The business that they had before the recent growth wave was prepared to handle the recent growth wave. So far, nothing is seeming like they're stretching. Usually you see liabilities increasing when there's production increasing. These stable liabilities imply that there's something to do with pricing power here. Let's just go straight to note 10 now. I'm curious. Everything else honestly looks fine to me. Okay, inventories. A majority of the company records inventory at the lower of cost or market or net realizable value as applicable. Approximately 82% and 81% of the company's inventories are valued at the lower of last in, first out cost or market. This is a large business. It's $1 billion business, $5 billion business, or something like this, right? Like, what that means is they're subsidiaries. There are many products. In fact, we absolutely should get a feel for what the products are in order to really kind of have the mastery of this section of this financial statement. But with so many products, even this is giving us a hint. One of the better aggregate level ways to start understanding the specifics of their business is to realize that only about 4/5 of what they sell is valued at market or recent cost. That means those are things that they expect to sell very quickly. That's typically what that means. Things that they expect to potentially sell over in a long period of time. So they built it and they don't expect it to sell until maybe next year or a couple years out. Those would be about 20% of the business. And so 80% of this business is stuff that they produce this year, they expect to sell this year. 20% is more long-term duration inventory. Let's look at this note here. If the first in, first out method was used for all inventories, this would be if we assume that everything would be sold long term for the extra 4/5 that we're assuming we're going to be able to sell in a short term basis. The inventories would actually be higher. Now, what does that mean? That means that the cost of production has decreased in recent years. That is interesting. That speaks to two things, potentially. Either there is an economy of scale here, which we could salivate right now. We can put fireworks or something. Economies of scale are the most beautiful things in businesses. As they made more, their costs have actually been decreasing recently. That also is congruent with their income statement, with their retained earnings, as well. Alternatively, if they depend on variable input costs, say they use cocoa. I know that this company doesn't use cocoa as an input good, but say that they're dependent on the price of cocoa. Well, if the price of cocoa is decreasing, this could be a temporary shift. I don't think this sounds very temporary. In fact, the fact that they're highlighting it here instead of in a different way kind of makes me seem that this is touching on an economy of scale. Here they're telling us that they do have the worry of having excess or obsolete, in particular obsolete inventory. That's not something that every business has to worry about. This business does. This is not a ton compared to the figures we're seeing above here, but it is comparable to around a fifth of the work in process inventory. And so if this is what they're working on currently in this snapshot in this quarter, then roughly about a fifth of a quarter's worth of inventory was obsolete and had to be basically lost in terms of not being able to sell it. Again, it would be interesting definitely to see if that fifth changes and has a new sort of stable state as they're growing. Sometimes they can get that to be lower as they become scaled up. Sometimes it can get kind of difficult to keep it under control, and you can actually see this get worse. We could actually roll this up into saying that they would impact the cost of goods sold, so this would lead to lower gross margins. Back on the balance sheet, none of these other notes are really shouting out to me. We could look at goodwill, but it's not. It's about a tenth or so of total assets. I'm sure this company, if it's growing, is just having its phone ringing constantly from investment bankers trying to get them to buy things. I want to see where their money went in 2022. Why is their cash and cash equivalents actually lower than in 2021 when they made so much more money on the net income? Net income here, as we can see, really getting close to almost double what it was in 2021 and almost 8 times more than what it was 2 years ago. And where's the money going? Basically all into inventories and CapEx. Ooh, and an acquisition of businesses. That's kind of a big deal, especially for a company that's not used to having this much money coming in. The yummy. Even more than they spent on their acquisition of the business and everything else, the number one thing that they spent money on was repurchase of common stock. The context, they basically put everything that they made in net income last year into just repurchase of common stock. Take my money now, honestly. That's not real financial advice, of course, but this is a very wonderful thing to check out. Acquisitions. From time to time, the company enters strategic acquisitions in an effort to better service existing customers and to attain new customers. And that's pretty generic. I mean, it's fine. It's not a red flag or anything, but they could have done more than. Near the end of 22, we acquired Northwest Polymers, Cascade Polypipe and Conduit. And then in June, the big boy they acquired was United Poly Systems. I mean, Poly is definitely the name of the game here. Looking at what they've decided to give us on these rows, they gave us a little snapshot of their assets, of their balance sheet assets. That's really nice, actually. That doesn't happen always. Intangible assets. A lot of people get a little bit spooked by this. This is things like brand name. This is things like the software they use, the licensings that they have. If this is licensing, maybe we like it. If it's brand name, I don't know. United Poly might mean a lot to some people, but it's certainly not the brand where you're paying almost 10 times the cash they have on the balance sheet. The fair value of intangible assets. Thank you. They broke it down for us. Let's see what is going on there. Customer relationships. So that's interesting because it's not a brand name, but it's not licensing deals. You can't force a customer to be your customer this year just because you acquired the company. That's not, licensing, you can force people to stay in business with you, but customer relationships are not. So this is kind of in between, very interesting. It's better than just brand names, not as good as actual license agreements. And its management said this was to attain new customers. Seems like they just purchased a company in order to get a whole bunch of new customers that they themselves are valuing at about 111,000 million, 111,000. So this would be about 111 million. Continuing here, we can kind of see they broke down pro forma net income. Now this is, and they'll even say here probably, here is illustrative purposes only, all this other thing. This is to illustrate that in their mind, they're going to be making an extra 900,000 roughly in net income every year, combined with this weighted average useful life. We should see this as oscillating. This is going to be their estimate for that year. And as you can see, it's already very different than the estimate for a year before. But roughly, this is going to be some sort of trend that they can expect to see as additional or additive to the business they had prior to this acquisition for about 11 years. Now, 11 years seems kind of large. I don't know how common it is in this specific industry, but 11 years is quite useful. Let's say that they really misjudged and after 5 years it's done. They're still going to get about 5 years of solid impact from these customer relationships. That's kind of okay. I mean, I do hope it lasts 11 years. I hope it lasts for them as long as possible, 15, 20, 111 years. But if it is less than what they're using for the acquisition justification, for the purchase price justification, then it's going to be relatively safe. And so are these assumptions reasonable? 900 net income. Let's compare that to the net income change that they have. And let's remember there's 11 years. Okay, we're back at the net income statement. Compared to 2021 to 2022, they made about a little less than 400,000 extra. During 2022, about midway through 2022, they acquired United Poly with a purchase price saying that they would roughly be able to add 900,000 extra in net income. So what we're looking for is in 2023, are we close to that 900,000? I mean, what we're basically saying is that this roughly was getting close to doubling the net income. If this purchase was done intelligently or based on their assumptions that they're willing to share with us, that's what I mean by intelligent. They're kind of aiming to be on track to doubling roughly this again. And so we're looking at certainly over $1.5 billion of net income for 2023. That's quite interesting. That is a lot of growth for any company. They're not saying that that's what they want, but this is kind of the hidden meaning of what that acquisition was, right? They received a bunch of money between 2021 and 22. They used the bulk of that money to purchase back stock. The rest of that money they used to grow inventories and to purchase companies, including almost all of it went to United Poly. The acquisitions themselves, they're claiming that the price they paid would be justified by seeing this almost doubling of net income next year and having that be potentially in effect for about a decade to come in the future. This is a really good acquisition, even if some of those assumptions don't play out fully. The fact that they're being so aggressive with how they're sharing the rationale for the acquisition tells me that they're very confident that it was a good thing to do in a space that they understand. Net income is very likely to go up if the business is allowed to sell those inventories. Now, there's always the very real question, the $1 million question is, we would know the future if we knew, are they going to be able to sell those inventories? We also know that some of those inventories are coming from acquisitions. Not all of those inventories were them scaling up. As they integrate with the acquisition and or continue to grow, are their costs, their selling, general, administrative, SG&A, are these going to start to grow or continue to grow past the point at which net sales grows? Or are net sales going to just continue to shoot very much like a rocket, really, allowing them to profit off of additional business that's coming into the door? This business really, really has a solid foundation in terms of that it's acquiring net sales at a very healthy clip. Again, very few companies are able to just pull in net sales this quickly. And beyond that, they've been pretty good at maintaining their costs and their liabilities. The riskiest thing they did, quote unquote risky, is acquire a company that they think is so beneficial to their bottom line that they're able to make claims like for an 11-year fair use estimate, we're going to be seeing almost a doubling of net income. Even if they make it to a half or a third of what they're expecting, this would not be a terrible way to spend money, to grow your net income by a third next year and have that be in effect for about a decade, or say even 5 years, really. That would not be a terrible way to spend income at all, or the money that's come in recently at all. And so a company that has a product that people just can't get enough of, using that money in ways that certainly are not stupid. I wish them lots and lots of luck, honestly. This is just a momentary thing where if competitors start coming in, I hope you guys can do the best to defend your business. If it lasts for a long time, then all the best of luck. I'll definitely be keeping an eye on you guys. Well, thank you guys for walking through the financial statements of Atkore Inc. with me. There's so much more in the 10K than just the item 8s, but really that is where the bulk of it goes in. I also like to look at what the business themselves identify as risk to the business. I also like to look at what different auditor statements say at the end. We looked at one of the auditors, but there are multiple auditors that come into play in a full 10K. And also just explanations of what their products are. Many businesses are very generous in giving you detailed information about the specifics. We didn't look through any of that because that's not what this is for. This is to get you comfortable to start. As a reminder, this was not advice to invest in Atkore. This is not advice to invest or not invest in either way. This was simply a walkthrough to help you get more comfortable. This was Sage Seeds Cap, and please don't forget to like and subscribe, and even more importantly, don't forget to share your wisdom. Oh my goodness, I love this.